We all think we may have an edge when it comes to investing, but the sad truth is that our abilities quite often don't quite meet up to our self-belief. We can read lots of newspapers, read the Investor's Chronicle, but the more we see what others are saying, the more we realise that they don't know any better either. If you need proof, then just have a look at how many expert fund managers don't actually beat the index. A recent study by Vanguard concluded that a staggering 89% of active funds failed to beat the benchmark index in their country. A report by Huard Ennisknup, I'm quite sure if I got that right, anyway, concluded that only 2% of fund managers beat their index by more than the fees. Incredible. Anyway, it would be easy to conclude that the best thing is just to buy an index fund. Just buy a tracker fund and just follow Warren Buffett's advice that if he were to advise his family what to do after he passes, is basically just to invest in the SP 500 index tracker. And that's from one of the world's most successful investors. While there's nothing wrong at all in investing in tracker funds, I truly believe that history has shown that with the right investing criteria, you can beat the index consistently. It isn't easy because you need discipline, but in this video, I'll show you the book that changed the way I invest in shares. I'm Anthony, and as always, we're talking money. This video is going to concentrate on the one book I urge you to read, and it's basically the Zulu Principle by Jim Slater. He actually came up with two books. He's got the red one, which is just the Zulu Principle, and then he's got another one which is Beyond the Zulu Principle. Very original titling of his books there, but anyway, it was written by the legendary investor and industrialist Jim Slater. A little background first off. The Zulu Principle is so named because Slater observed that his wife, who studied African studies, then concentrated on the life and times of Zulus. After a time, a relatively short time of studying and concentrating on a niche, his wife soon became a world's leading expert in Zulus. So while in hospital with time on his hands, he applied the same principle to investing in shares. He concentrated on a niche within the market, which he thought would deliver the greatest returns. This area was growth shares, i.e. ones whose characteristics was capital growth. He focused on the characteristics of those shares that demonstrated capital growth, and the book The Zulu Principle are his explanations and conclusions. Essentially, it's a menu of investing criteria that seem to be present in shares that have demonstrated impressive stock market growth. The thesis is that if these criteria are present in these shares, then we can search the whole market for shares with these criteria and hopefully find those shares that will demonstrate the same growth in the future. This we can do on the computer. I'm using Stockopedia, and looking at the Zulu Principle screen in Stockopedia, this shows the last 8 years' performance compared to the index. And if you wanted a real life performance, then I can show you my growth fund portfolio, which is based on the Zulu Principle and Jim Slater's criteria over the last year. It differs from the other screen in that in practice I don't tend to sell my shares unless they've both dropped from the Zulu screen and they've fallen through their stop loss limit too. That's why I've got more shares in my portfolio than the Zulu screen. By the way, if you wanted to try Stockopedia for an extended trial period and get a 10% discount off their annual subscriptions, I've now got a link in the description below which you can click on. So what are these criteria that Jim Slater identified? Well, essentially they boil down to those criteria that are more or less essential and those that are strongly desired. I'm going to give you a summary because, as you can imagine, you get a whole lot more by reading the book that goes into more detail and gives you more rationale behind the criteria. So let's have a look at those criteria that are essential first. Now, I'm assuming some knowledge of some basic terms. If some of the terms are a little bit unfamiliar, then pop on to somebody like Investopedia.com because they have a fantastic, easy to read summary of all the sort of investing terms that people throw about, but I'm not going to go into really complex terms really. I'll give you a brief description as we go along anyway. Right then, the first criteria that Slater identified is that growth shares tend not to be very large companies. He saw that shares that tended to grow quickly were relatively small to start with. Those massive FTSE 100 shares worth many billions were unlikely to be nimble enough to demonstrate explosive growth or be so far unnoticed by the market in general. So he sifted the market by identifying shares that had market capitalizations of under $1 billion but over 100 million. So in that sort of bracket really. The next criteria was to have a price earnings ratio of less than 15. Clearly you don't want to be buying shares that are already fairly expensive to start with, so having a figure in mind is quite useful. He identified as 15 as being a pretty simple level, that under which you stand a better chance of observing a growth share. So now you have a group of small companies, relatively small companies, that are relatively cheap compared to the market. The next thing you want is a company that has demonstrated rapid growing profits. And hopefully you want companies that have demonstrated an earnings per share growth, an indication of profits as it were, a growth rate of over 20% a year. That basically means that profits are growing 20% on top of last year and then another 20% on the next year. To make things a little easier, when comparing different shares, you can compare the PE ratio with the earnings growth rate. And this is better known as the PEG ratio. It's something that made Jim Slater quite famous. He was the one who sort of had it in his Zulu Principle book. And it's quite simple to get your head around. It's if a company has a PE ratio of say 12 and an earnings growth rate of 24% a year, that would give you a PEG ratio of 0.5. It's just 12 divided by 24. The Zulu Principle identified that good growth shares as having a PEG ratio of less than 1. So P ratio of 12, growth rate of 12 gives you 1. The next criteria is that the company must demonstrate that it's beating the rest of the market. This relative strength against the market and their peers is proof positive that the company is already being recognised as being a good market leader. Relative strength can be easily measured over a month, 3 months, 6 months or a year, and Slater's criteria said that the company must show positive relative strength over the last 12 months and also the last 3 months. The next criteria is return on capital employed. Now this is a simple measure of how well the company is converting its capital into profit. Growth companies are very good at converting their capital into profits. You could say that it's a measure of how efficient they are at making profits out of their net assets. The Zulu Principle puts a figure of over 12% as a criteria for growth shares. Those are the main financial numbers behind the Zulu Principle. There are some other ones too, such as liquidity and cash flow measures, and there are also some non-financial elements too. Some of these would include a positive chairman's statement, some kind of competitive edge in the marketplace, directors buying into the company. The Zulu Principle was written in 1992, and some of the examples now seem a little outdated, but the examples are just meat on the sandwich. The principles themselves don't change and are just as relevant today as they were nearly 30 years ago when he wrote the book. The main thrust of the book, though, is covered really in the first, 39 pages or so. The rest of the book giving the reader a much fuller explanation of how Jim Slater sees investing ideas in general. It is interesting that the first 39 pages could have been expanded upon, which he did indeed, but only in his second book, the purple book here, called Beyond the Zulu Principle. In my humble opinion, the second book could have been included in the first, but you know. Now these search criteria only really are useful if you've got some method of searching the whole market by those criteria. In the old days, you used to be able to buy CDs every month or every quarter that contained all the financial data required to search the entire market. Then came the internet, which did make things a little bit easier, but searchable databases only existed with the excellent company called Company Refs. But even then, you could only access it at in my case, you could only access it at weekends. You had to pay a lot more if you wanted to access it every day. You could put up with these slight inconveniences because being able to search the entire market by key criteria and end up with, say, half a dozen shares that met all those criteria was really quite invaluable. Today, however, you do have companies like Stockopedia. I do mention them quite often, but they are excellent, which is an immensely powerful platform. Jim Slater's criteria in the Zulu Principle can be used to search over 63,000 shares across the world if you have the full global subscription. Time and time again, the relatively simple criteria and philosophy behind the Zulu Principle has proved to be a market beater. Of course, there is a possibility that this can change, but 30 years is a pretty good benchmark to go by. And the thoughts that have gone into making these criteria have a sound basis on which there's very little reason to see why they wouldn't identify future growth shares. Anyway, I have put a link in the description below. I think it's an Amazon link where you can get the book from. I think it's still in print, but if it isn't, then there's loads of second-hand copies around. So there you go, that's my little summary on the Zulu Principle. I think it's an excellent book if you're getting into investing in shares in the UK or America, and yeah, it certainly stood me in good stead, and it's proved over the years to be a beta of index tracker funds, certainly for me. And so yeah, I thoroughly recommend it. Anyway, I'm Anthony. I hope you've enjoyed the video, by the way. If you have, hit that little subscribe button and the notification bell and the thumbs up and everything like that. It really helps the channel out. Anyway, I'm Anthony, and as always, we're talking money. I'll catch you in the next video. Bye for now.